JJ the CPA here. All right, a little old school, not in the studio. And I am going to make use of about a 20-minute drive here. And I know some of you are like, oh, it makes me nervous when you video and drive. But I think you'll see I'm pretty good at it. So what am I going to talk about? What do you want to talk about? Well, here's what I want to talk about. Let's talk business. A few things on this. I'm going to cover a number of things. Number one, I'm going to cover why it is the wealthy can pay zero taxes. All right, so the wealthy pay zero taxes. Boom. It's possible. You know why? Yes, because of the tax law. And I know that it's, for some, it's just makes their blood boil, right? But, you know, really at the end of the day, if you're upset that someone pays zero taxes, then you're just upset that someone's paying zero taxes. But the way that you can have somebody pay zero taxes is that they are spending a lot of money, borrowing a lot of money. I have clients that, you know, they're probably acquiring 1 to 2 different businesses every year, including real estate. And when you're investing in companies and you have passive income, passive losses, you might have at-risk basis and tax basis, you're able to use your money that you have left over, that you're going, what should I do with it now? I guess I'll make more money. And the investments, and I don't mean investments into Walmart stock. So the wealthy makes direct investments. Direct investments is they actually own the commercial real estate. They own the building. They invested in the restaurant, not just bought stock in a restaurant. And so when you're having direct investments, so direct ownership, and you're putting money into it, you have basis, you have skin in the game. So if the business loses money in the early years, whether it's depreciation or getting a business off the ground or whatever the case is, whatever percentage you own of that business, you're entitled to losses to the extent that you have skin in the game. Now, if you're not active in the business and it has losses, those are called passive losses, and they're then only able to offset other passive income. So think of that. You can have the wealthy that can, in essence, you know, have business losses. And I think the misconception is that a business loss means you lost money. A business loss is that expenses for tax purposes exceeded income for tax purposes. And in the early years, you're able to potentially easily see how that can be, or if you're buying up a lot of equipment and you have a lot of expenses. So that's probably where the wealthy just got everybody fooled that, oh, I've got business losses, so I'm not making any money. Well, and with proper tax planning, you know, you can have a lot of expenses at the end of the year with prepayments, et cetera, et cetera. So there's lots of easy ways to have business losses for tax purposes. And when you're then looking at these losses that are passive, I have clients that have lots of passive losses. You know, they've had losses, they've gotten into owning businesses, and they're not actively involved, so that makes it a passive loss. And so over time, you know, whether it's 1 year, 2 year, 3 year, they've amassed a large amount of passive losses. So then guess what happens? When that business starts having net income, the losses from the prior years, because they weren't able to be taken if it didn't have passive income to offset it from any investment. Long story short is those passive losses that have carried over and carried over and carried over now are going to offset any future passive income, whether it's from that investment or another investment. And wealthy will know that they've got a business that's successful and it's going to have some passive income. And so they might look around and go, well, what can we start up? You know, what should we get rolling here? And the wealthy don't spend money just for tax purposes. They don't just have business losses for tax purposes. I do have, you know, when I first started, I had people that would come to me and they're like, well, listen, I heard that if I have a farm, I can have a loss. And I was like, you know, the first thing is you got to spend money to have a loss. And you're never going to come out ahead with a loss when you take into account the tax savings to then justify a loss or justify spending money. So never in the history of history with JJ the CPA have I told a client, well, let's go find some losses. Let's spend some money just for the tax purposes. Now, yeah, we've had those discussions, and it would be for an overall standpoint, but it's not just spending money just to save tax. It'd be spending money to invest into something, whether it's equipment or vehicles, things that are going to, in the future, produce income, but in the year of acquisition, taking a big deduction. But money was spent, money was borrowed, skin was put in the game. So it is unfortunate that for employees that rely on the business owners to have a regular paycheck, that aren't taking on the same kind of risks that a business owner takes on. Of course, an employee in some ways takes on more risk than a business owner because they got one source of income, and if that employer is no longer, they don't have a source of income, where a business owner in that regard takes on less risk because they have hopefully multiple sources of income, as in multiple customers or multiple types of services or products they're selling. But the risk of, is that actually going to sell? Are people going to buy? Am I going to buy a product that people will then buy from the business owner? So there's investment risk. Money was put in, money was borrowed. And the thing to know is you can do it. People that think that there's the wealthy might have decided they're not part of that. But we live in America, and everybody has the ability to be wealthy. And when you look at the stock market or social media, or you look at commercial real estate or speculation or good old-fashioned starting up a business, every single one of you that's watching this is either wealthy, on their way to be wealthy, or just deciding, you know what, I don't really care about being wealthy. You know, that's not a big deal to me. I don't need that. Which is great. That's probably a wonderful position to be in. The point is, everybody has the ability to be wealthy. And I understand it's like, oh, we inherited money and this and that. Well, that's just jealousy. I didn't have a pot to pee in. I'm driving a Jag. So anyways, you all, I just love you guys. Anyways, from the standpoint then of the wealthy not paying taxes, well, they're making investments, they're spending money. It's just ignorant to think that oil must be doing wrong or you're taking advantage of the laws. These are basic laws. Basic laws. And when you read things honestly in Forbes magazine or Money magazine or New York Times or whatever, I mean, no offense, New York Times, those are the most basic strategies. So, I mean, it was a novice that looked over those tax returns, a novice that clearly doesn't even know what they're looking at. So when you're talking about, you know, passive losses and active losses and those kind of things, I mean, this is obvious stuff, and it's the law that, quote unquote, actually disallows losses. And, you know, for somebody that has losses year after year after year after year, and they never actually took those losses, most likely as being less aggressive than many that are on their way to being wealthy, try and take advantage of losses that are actually passive, and they don't get to take them in the current year, and they're supposed to carry over. It's kind of becoming a top 10 issue for the IRS to be interested in, which is this. You have people that they're invested in a business, they have skin in the game, that business does yield a loss for whatever reason, based on what I just told you, but they're not actively involved, so they don't actually get to experience the passive loss if they don't have any other passive income. So when you hear of somebody that has large losses carried over, actually that's probably a non-aggressive tax position. It's non-aggressive. Aggressive is, well, I'm active in everything, and so I'm taking losses on all this stuff. Now, what you got to pay attention to here is that if you aren't actively involved in the business and you have passive losses, if you have ownership in other businesses that you're not actively involved with as well, but they're yielding net income, passive income, well, passive losses can offset passive income. Passive losses cannot offset active business activity income. So in my CPA practice, I'm active. If I had a business that I was involved with, invested in, had skin in the game, it yielded a losses, but I'm not involved in it, okay, day to day, I'm not participating in it. So it's passive. So whatever net income I would have for my CPA practice, I would not be able to offset it for tax purposes with a passive loss. That passive loss would have to carry over and carry over and carry over until I have passive income. And so, yeah, somebody could say, oh, well, that's really taking advantage of the tax law and you're manipulating it and you're extorting it and you're doing it improperly. Well, actually, that's a really conservative position to take, which is, all right, yeah, I'm not actively involved. Yeah, I got these big losses here that could maybe save me $5, $10, $15, $20, $30, $100,000 in taxes. Maybe not necessarily me. But I'm going to look at these losses and go, yeah, well, the tax law doesn't allow me to take these in the current year because I'm not active. And so then you have a loss carryover and a loss carryover and a loss carryover. And then, yeah, when it has net income, guess what? They don't have to pay tax on it because they have losses that they haven't experienced yet that are offsetting it. Boom, wealthy don't pay taxes on those kind of things. Now, that probably doesn't last forever and ever and ever if you are just using the same businesses. But the wealthy can get into new businesses, get out of businesses, get into new ones, make investments. So I don't know that that causes there to be any quote unquote wrongdoing, that they're making investments, especially if they're making investments, it's yielding a loss and they have other passive income. Well, they have skin in the game. They got the loss. If it's passive and they have passive income, they're getting to take it. So is that unfair compared to an employee that when they earn their income, they have to pay tax on it? Well, just different circumstances. It's different circumstances. So someone who has passive losses actually can only take it against passive income. They don't get to offset it against wages. They don't get to offset it against active income. So technically, there is no comparison there because an employee is paying tax on its earned income, its active income. A wealthy individual is paying tax on its active income, its wages. It actually cannot offset with passive losses. It cannot offset their earned or active income with passive losses. So in the same position. So if you own a business and you're active in it, well, then those losses can offset other wages. It's just, well, are you having losses because you're going out of business? Well, then, yeah, there's no reason to keep going to have losses to offset your income, because whatever your loss is, 10 grand, let's say, it's only going to save you maybe $3,500 in taxes. You're still in the hole $6,500. I did a video, you can go back and look at it. I did it on Friday, and it's talking about capital losses and capital income, and it's the same thing. So capital losses can only offset capital gains. So someone may have huge capital losses, and therefore they sell off future stock. Well, those future stock and those future capital gains, they won't pay tax on because they have losses that they have from prior years potentially, and or the wealthy may have a huge stock portfolio. They need to unload some stock. They're going to have a huge gain in it. So they look at their portfolio of stock and they go, well, is there something I should sell off that's a real loser here? So that this would be like stock. This wouldn't be like you own the business per se. Okay. Now, if you're super wealthy, you may own a business and be able to sell the stock and it's outright and have a loss. But the wealthy will look at that and go, well, you know what? This investment here stinks, and I don't think it's ever coming back. And I've got a huge loss that I've not been able to take advantage of yet. So I think I'm going to go ahead and unload on this at the same time that I unload on the gain, and therefore they cancel each other out. But the reason they cancel each other out is that they had a loss to offset it. Now, if you're following me, a wealthy person doesn't get to sell stock at a loss, and if they have no capital gains, they're not able to offset it against active income and or earned income. They can't offset it against interest and dividends. So the thing to note is that for the wealthy, like the super wealthy, the reason that they're not paying any taxes, if you will, is that they're able to continually increase their portfolio, which a lot of times is with loans, which, for somebody that's, I don't know what your definition of wealthy is. For people that, follow Dave Ramsey, which is great, I think, for people that don't own businesses. But if you follow Dave Ramsey and, debt is evil in all its forms, well, the rich get richer because they borrow money. They have money. That's how they did it. And if they're passing the wealth on, it's going to go into my next subject, which is whole life insurance. So you look at the Rockefellers, look at the Kennedys, Trumps, just name them, right? Name them. They all have a ridiculous amount of whole life insurance. But you know what the secret is? And this is where you're not going to even believe me, and so I'll have to do a different video on it to give you the details. But this is where the wealthy are able to, and if you don't understand it, because when I talk to clients about this concept, because I have a ton of clients that do this, and I do it as well, they all they hear is one sentence that you're getting ready to hear, and then they can't hear anything else. They just don't have the ability. Now, for the 400 people that watch my Sunday morning video, I love you, and you will hear me, you will listen. I'll do a more extensive video, but the bottom line is that it typically is not that smart to get whole life insurance on yourself when you get up in age. Up in age would be, maybe above 40, if not above 30. And the reason for that is this, and it's simple. When you buy whole life insurance, there's going to be a cost to the life insurance. The cost of life insurance, whether it's term or whole life, the actual cost of life insurance is going to cost more when you're older, because there's a greater chance you're going to die than if you're 30. So if you're 55 years old, the insurance company is going, well, you have a life expectancy is this, so there's a greater chance you're going to die versus a 25 or 30 year old. So when you're looking at whole life insurance and you're just looking at it plainly and you're not assuming it's snake oil sales, you are looking at what's the insurance cost inside of the whole life insurance, permanent life insurance. That's what you want to look at, to then go, well, how much goes to cash value? And for people that aren't necessarily looking at, well, I've got plenty of money, what else would I like to do with this? Or I'm behind on retirement, what should I do? And so they're just looking at a Money Magazine article. They're not taking into account what they see when they look at an illustration, which is like, oh, well, there's hardly any cash value after 1 year. So when you're looking at whole life insurance, which is very complicated, you have to look at, well, but what's the fair market value of what my investments could be? Because when I sell them, I got to pay stock, or I got to pay tax on it when I sell them, whether it's capital gains or if you're putting money into a retirement plan, whatever it's worth in retirement, knock off even 30%, because that's what you'll have to pay in taxes. So if you have $1 million in retirement, you actually only have maybe $700,000 for retirement after taxes. So the benefit of whole life insurance is that you're able to get back to the money in a proper plan, and you're able to get back to that money tax-free because it is a policy loan, okay? It is not pulling out income. You're pulling out a loan. And then that's where the shaft comes on probably 90% of whole life insurance out there. And so I work with the one company that I represent for whole life. I can sell whole life insurance any company in the nation other than Northwest Mutual, because I won't. But I can sell whole life insurance any company. I can sell life insurance any company, State Farm, Geico, Mass Mutual, New York Life. I can sell them all. I can sell any whole life insurance in the United States of America. Guest of Mark Burson. Guest of Mark Burson. Burson with a B.
Is he a resident?
No.
Okay. You're going to Country Club?
Yes, sir.
Okay. Thank you.
Okay, thank you. So what you have to look at, though, is one thing. One thing. And the first thing, obviously you got to look at a number of things, but the first thing I look at, and there's only one company out there, one that has a 168-year history of doing this one thing that you have to be sure of, which is if you're going to borrow money from a whole life insurance policy, you have to ensure that the policy loan rate, meaning the rate of interest that the insurance company is going to charge on that loan, is greater than the dividend that the cash is going to earn. So look at it this way. If you put money into the bank and you borrow money from the bank, so let's just say for grins, you put it in the bank and they're going to pay you 4% interest income. And then you borrow money and they're going to charge you 3% interest expense. Well, you'll never lose your principal as long as your money's making 4% and you're only having to pay 3%. Assuming no principal has to get paid back, which with the whole life policy, it doesn't need to get paid back. So what you have to look at is, will it ever implode? So you have to go with an insurance company where the policy has never imploded in the history of the company. You have to go with an insurance company that they have a historical, they historically have always had a dividend rate that's higher than the policy loan rate. You have to go with a company that's been paying a dividend for 168 years. You have to go with a company that is mutually owned, in my opinion, because it's owned by the policyholders, which means it's held by, in essence, those that have the policies, which there is no benefit to the policyholders for a policy to implode. So the thing is that, and I teach this across the nation, and honestly, I decided to stop teaching it to CPAs because they're just so thick-headed and just, they hear whole life insurance and they assume you're selling snake oil, and it just gets out of hand, and they're rude, and it's unbelievable, the reactions I get. So I don't do those seminars anymore on behalf of Surgeon. But at the end of the day, what you have to look at is, people will put money in a 401k, they'll put it in the market, and they'll just go, oh, well, it's in the market, everybody's in the market, it's going to pay a dividend, nothing could go bad, so I'd rather put money in the market. Whereas if you're looking at a whole life policy, and if it's done properly and you're with a proper company, and you look at their history, and they're paying a dividend, and they have zero debt, they're paying a dividend, and they've always paid a dividend, even in the greatest of worst times. They've never had a policy implode because it's always going to make more money. The cash value is going to grow. The death benefit's going to grow. So you have to look at these factors. The second biggest item to look at. So the first is that the loan rate is less than the dividend rate. Okay. The second thing to look at is the life insurance death benefit going to grow? Because if it's going to grow, then there'll always be enough death benefit to pay off whatever loan there is. So if you have a policy that's done properly and the death benefit continues to increase and go up, and as you potentially borrow money and the loan value or the loan goes up and up and up, you have to look at these as three different categories. What is the death benefit? What's the cash value? And then what's the loan? Well, as long as the cash value is more than the loan, and as long as the death benefit's more than the loan, it'll never implode. So the wealthy get, you ready? You ready? You ready for this? The wealthy gets whole life insurance first and foremost on the kids when they're born, on the grandkids when they're born, as much as possible. And the reason that everybody just flips out, wigs out, can't believe it, heads pop off, now I can't hear anything else you just said, is that it is, I do understand that, when we have kids and grandkids, especially when they're born, it is true, they'll never die. They'll never die. Well, we all know that's not true. The second thing is they're like, oh my gosh, you're getting life insurance on your kid. I would never want to profit from the benefit of my kid dying. Well, of course not. Tell me one parent that's going to buy life insurance in hopes that their kids die before they do so they can get life insurance. Okay? What you have to look at is that you're actually getting life insurance, and if you're getting it on your kid, you're assuming they're going to outlive you. They're assuming whether you're the parent or grandparent, but it's going to the next generation. It's going to the kids' kids. The death benefit, your kid lives to 75. Most parents aren't around. And so who's actually going to benefit from that life insurance policy that you got on your kid? Okay? That kid's heirs, that kid's family. And when you get whole life insurance on a baby, the costs are like this. And when you're socking in cash, boy, it's just all going to cash value. Much more is going to cash value. You can get that thing paid up in 10 years. You can just sock it through, and you can sock it through, and you can sock it through. So another way the wealthy don't pay taxes is that when you pull money out of a whole life policy as a policy loan, there's no tax due on it because it's a loan. When you do generational strategies and you have money that is then put into these policies, it doesn't create an estate tax. You're able to skip that. You're able to give money in the seed that then grows, and then there's millions and millions and millions and millions of dollars that when that baby turns 75, 85, 90, or lives to 185, there's a tremendous amount of wealth that is then able to pass on to the next generation. Boom, bada, boom, 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 boom. Income tax free. Let's go. Now, they didn't get a deduction when the money went in. That's the key here. You don't get deduction when the money goes in. So you got to look at it super careful. Mass Mutual. That's all I can say, because I've given you some examples, and I'm not representing anything to you. You're going to have to talk with a professional. You're going to have to look at it. And there's lots of provisions, but there's really one company out there that meets all the goals. I hated whole life insurance. I hated anybody that sold whole life insurance. Hated them, hated them, hated them, hated them, hated them. And that's an understatement. I burned bridges. I fired clients that bought whole life insurance. I wouldn't tolerate it in any way, shape, or form until I discovered how it actually works, looked at how it works, and then looked at it over and over and over and over, and spent probably 5-6 years finding the holes. And then when the light bulb goes off and you find the right company that meets all the goals, and then 168 years, it's done everything it said. In 168 years, there's no debt on the books. Their biggest asset is policy loans, which means they want to protect it. They don't have to make a dividend for the stockholders. They're just making dividends for the policy holders. And they've never had anything implode. Then you go, oh, that might make a good policy. That might be a good item.